What I have for you this week is the 2020 and the 2022 decisions of the UK First Tribunal and Upper Tribunal in the BlackRock decision. It is a complex, factually dense decision, so let's get going. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. If we look at the facts, here you can see BFM, which was BlackRock Finance something in the US, which was a subsidiary of BlackRock Inc. And it received $2.25 billion in cash and $8.5 billion in BlackRock Inc. shares. And what it was going to do was it was going to buy Delaware Holdings Inc., another US company, which held a lot of Barclays Bank's investment activities, and that's what BlackRock wanted to acquire. It was a huge deal at the time. It happened in 2009, and BlackRock inserted a number of LLCs in between, and you can see there's squares and circles, which means that these were hybrid entities. They were tax transparent for US tax purposes. Now, 2.14 billion of the 2.25 billion went from BlackRock BFM to LLC4, and then LLC4 contributed that to LLC5, which pushed it down to LLC6, and LLC4 also gave 107 million, the difference between 2.25 and 2.14, to LLC6 for ordinary shares, and LLC5 got preference shares. And then LLC6 used both the shares and the cash that it got to acquire the Barclays target. Now, LLC5 is what the case is about, because LLC5, even though it is a Delaware entity, was tax resident in the UK, and it was treated as a taxable entity in the UK. And there was a $4 billion loan from LLC4 to LLC5, and it is the interest deductions of this loan that we're going to be talking about. Now, the picture on the left is from the Upper Tier Tribunal. That's how they explained the case. The First Tier Tribunal have a slightly different picture. It only focused on LLC 4, 5, and 6, explaining that it was US and tax residents 4 and 6, and 5 was the UK resident, and then it has this $4 billion loan. Now, if you look at the facts, there's something that's a little unclear, right? Because there's $2.25 billion in cash and shares going all the way through the structure until it goes down to Delaware Holdings Inc., and that was the purchase price for the shares. I should say this right. The owners of Delaware Holdings Inc., I believe, did get the 2.25 and 8.5, and that went all the way through the structure. And the question is, what did LLC5 need the $4 billion in loans for then, right? Why is there another $4 billion in loans? And neither the First Tier nor the Upper Tier Tribunal is quite clear on this. If you know more about the case, feel free to add some comments below. But there is this piece in the First Tier Tribunal decision where it talked in point 10 about a press release from 11 June 2009, before the actual acquisition took place. Barclays and BlackRock announced this acquisition, and it said under the terms of the transaction, BlackRock would acquire BGI, Barclays Global Invest, I believe, in exchange for 37.8 million shares, and that's the 8.5 billion worth of BRI shares, and a common equivalence in BlackRock, that's the shares, and 6.6 billion in cash, not in case. Now, the 2.14 plus the 107 plus maybe another 4 billion would give you the 6 billion. So I'm not sure whether this loan of 4 billion was subsequently also contributed as cash down to LLC 6, and whether there's simply a typo in the way the court has made the pictures. The shares would represent 4.9% of voting interest and aggregate 90.9% of economic interest in the combined firm, which would be renamed BlackRock Global Investors. And this was by far one of the biggest deals of the 2000s till then, and it did change the investment industry. The court quotes papers 10 years later still referring to that. So just to look at the facts as the Upper Tier Tribunal described them. They say BGI was acquired by BlackRock. The steps involved was set up by E&Y. On 16 September, LLC 4 and 5 and 6 were registered and incorporated. On 30 November, that's when the deal took place. BFM incorporated LLC 4, LLC 4 incorporated LLC 5, LLC 4 and 5 incorporated LLC 6. And then we go further, and on the 1st of December, so the next day, BFM contributed this 2.2 billion and the shares. You can see 37,566,000 shares to LLC 4. It contributed the shares to LLC 5 in return for 100 common shares, and it also gave them these 4 loans of 4 billion. These loans were for 1 year, 2 years, 3 years, and 4 years, if I remember correctly. And the longer the loan, the higher the interest. It went from about 2% to 6%, but that was changed later, so it's no use of focusing on that here. LLC 4 contributed 107 million to LLC 6, as we saw, and it got the common shares, and LLC 5 contributed 2.1 billion in cash and the BRI shares in return for preference shares. Now that is something else that the court doesn't discuss, but which is quite strange. I mean, if you look at the contribution from LLC 4, it only contributes 107 million, right? But it gets the ordinary shares. LLC 5 contributes many more times, so its economic risk is much bigger in LLC 6 than that of LLC 4, but it only acquires preference shares, and one wonders whether the third party would have been prepared to do that. Anyway, the money then goes to LLC 6, and LLC 6 then acquires BGI US by acquiring Delaware Holdings Inc. So in other words, this was belonging to the previous owners, maybe Barclays Incorporated, or in any case the UK parent, in exchange for this money, right? And LLC 5 had a total of 2.4 million votes in LLC 6, and LLC 4 a total of 21 million. So also LLC 5, even though it put in much more money than LLC 4, it still had far fewer votes than LLC 6. This simply doesn't seem like a realistic transaction, one would argue. The votes was later changed and even became worse, if I remember correctly. So this is just what every share got, the $300 per preference share, and that should have been enough for LLC 5 to pay off the interest on its 4 billion loans. But in practice, that didn't work well, and it did have to take some loans from Delaware Inc. or from LLC 6, because there was some uncertainty about the consequence of dividend payments from LLC 6 to LLC 5. And let's look at the structure, bearing in mind the transparency for the US. So for the US, because everything between BMF and Delaware Inc., the target, was transparent. From a US perspective, it looked as if BMF Inc., which according to a EY planning memorandum was receiving a loan and the BRI shares from BlackRock Inc., simply used that to pay the owners of Delaware Holdings Inc. and became the owner, right? So that is the US perspective, nothing funny there. And then we've got the UK perspective that we've just seen, and there's some consequences to this, right? Because we've got the loan going to LLC 5, in other words, a lot of interest being borne in the UK and deducted in the UK. Now the problem is LLC 5 would have had almost no profit after it deducted its interest, and That problem was solved because BlackRock had some other profitable subsidiaries in the UK, and LLC 5 would simply surrender its deductions or its losses to these profitable UK subs, and they would then offset that against their UK corporate income tax. So not only would you completely erode the UK tax base of LLC 5, you would also increase the damage, if you want, by also eroding the tax base of other profitable UK subs held by BlackRock at the time. And this was made even more egregious by the fact that there was no taxable interest income in the US for all this interest paid by LLC 5 to LLC 4, because there was no LLC 4 and LLC 5 from a US tax point of view. So one might expect that HMRC was not very happy with this, right? But before we get to that, let's just explain a little bit more about the structure. Rather than a UK limited company, of course, why did they use a Delaware LLC for the UK, right? Rather than a UK limited company, the decision was taken relatively quickly for BGI to be acquired by a US limited liability company that was a UK resident. Mr. Fleming, this was the head of tax for EMEA, I believe, in BlackRock, believed that this change was because of potential changes to US check-the-box regulations that were anticipated to operate so that non-US corporations would no longer be eligible to make an entity classification election. So I think 2009 one should also think about pressure starting to piling up on Apple and on McDonald's and all those multinationals for not paying tax outside of the US, right? Although Mr. Fleming understood it was possible that any amendment to the check-the-box rule regulations may have applied to UK resident LLC, the risk was perceived to be much smaller. So they thought, you said, much of the structure dependent on the UK company being tax transparent and its creditor being tax transparent, and by making it a US LLC instead of a UK corporation, the chances of survival of the structure in future was deemed to be higher. And then we have a executive summary from E&Y on an advice that they gave to BlackRock on the 29th of July 2009, and it said the expected summary UK tax consequences of the transaction to fund the acquisition of BGI US are the interest on loan 1 that was down to LLC 5 should be deductible for UK tax purposes, and 2, the loan for an unallowable purpose provisions, so this is UK anti-abuse rules, would not apply on the basis that LLC 2 is making a third-party acquisition at fair market value. So there was UK anti-abuse rules which might have limited the interest deduction, but these did not apply when you had the transaction for commercial purposes. And since BlackRock was acquiring Barclays, or the US operations through this structure of Barclays, that was a commercial purpose, even though it was set up in such a way that the UK, which had nothing to do with the structure, a US company, BlackRock, was buying the US operations of Barclays, right? But they interposed the UK company there to get rid of some of the other tax burdens of other BlackRock companies. But that still would have been allowed under their expectations, because they were doing it for a valid commercial reason, being the acquisition of the US activities of Barclays. And then the first tier tribunal also explained what LL6 was doing, LLC 6 was doing in the structure, and says because of anticipated reservation of the OCC might have about the UK resident entity controlling US bank, UK Treasury consent rules, and most important, concern around the UK controlled foreign company rule, so another UK anti-avoidance rule that had to be dodged, it was decided to introduce a third LLC in the holding structure. And then Mr. So-and-so from Skadden has explained, this is a US law firm, the split ownership of the new LLC3 being LLC6 in our structures is intended to prevent the BGI US group from being considered controlled foreign corporations for UK tax purposes, not US CFC rules, but UK CFC rules. Although we think CFC status would be a manageable issue, there is little passive income in the group, and it will be preferable to avoid as a cost effort for future management and reporting would be reduced. So this was just a possible damage control issue, right? And then point 43 is an interesting one where it says, in addition to these documents, all of these were signed on the 30th of November. The following documents were tabled at the LLC 5 board meeting where they decided to buy Barclays, right? And then the fifth one was an opinion on the anticipated tax treatment of the proposed transaction from Kevin Prosser QC, Queen's Counsel. Now, so this was the barrister, and he basically said, you know, you guys don't have to worry, the interest will be deductible. Now, as the Upper Tier Tribunal decided, ultimately it's not, and one wonders what Mr. Prosser's professional liability would be in this. Judging by most opinions one see, and all the ifs and buts and covenants that they have to them, probably there would have been no legal liability, but it is a thought worth considering.